Hello and welcome to Business Today Television. I'm Siddharth Zarabi and you're watching Easynomics. On today's episode, we deconstruct the third quarter performance of the Indian economy, and joining me now is Saugata Bhattacharya, noted economist and chief economist at Axis Bank. Saugata, welcome to the show. The numbers are all out there and the broad consensus estimate is third quarter growth is likely to be below 5%. What are the numbers that you are working with?
Thank you very much, Siddharth, for this opportunity. Yes, we are also working with a sub 5%. In fact, we are quite sub 5%, 4.6% for GDP growth, and actual GBA, which is the real measure of economic activity, gross value added. It's about 4.5%. So all of this, the lower number this time is coming in essentially from manufacturing. So manufacturing and industry in general is likely to be lower, getting dragged. But more important than these growth numbers, because I think now the effects of the base effects of the pandemic and the following years, that's now wearing off. So right now we will be about 105, 106% of the pre-pandemic level. So if you assume that was at 100%, so we are climbing out. But obviously, I mean, given the headwinds, there is likely to be a slowdown in the third quarter compared to the momentum that we have seen. The double-digit numbers for the first quarter, and then the 6.3% for the next quarter for Q2. There's likely to be a slowdown.
Considering that there's been a pretty steep hike in the interest rates and the process of aggressive rate hikes, what kind of impact would that have had likely, Saugata?
So this is the remarkable part, Siddharth. Despite the very aggressive rate hikes, I mean 250 points of the repo and even more if you consider the actual money market rates, the movement up, it really doesn't seem to have had any significant material impact. Obviously, things have slowed down. In the third quarter results itself, you would have seen the fall in the sales revenues of companies, the listed companies that we track. But even there, the GBA, which is actually the profits for the company, helped by lower input costs, helped by lower growth in employee costs for services companies, profits and profit margins have actually held up. I mean, it's come down. Obviously, I mean, in many sectors, it's come down. And remember, this is the core of what goes into the preparation, into the estimation of the GDP numbers. We do expect a slowdown even further, although the base effect for Q4 will probably be about 4.9%, a little bit above. But we do expect a slowdown. We are seeing signs of a slowdown in credit growth, in credit demand, credit applications, etc. So we will head to a slowdown. And obviously, one of the key drivers for the slowdown is the lower export, negative export growth that we have been seeing for the last 2 or 3 months.
Beyond the normalization of the base effect, what do you expect, for example, on services sector growth?
So services sector growth this quarter in Q3 is likely to be about 5.7%. All of these, remember, are working estimates, because remember, one of the key changes that have happened in estimation of GDP over the last 4 or 5 quarters is that the NSO, the National Statistical Office, is now beginning to use GSTN data to proxy growth for the informal sector, this really micro and small businesses. So it's difficult to get a sense and particularly this is true for services. So what exactly is the extent of slowdown? But overall, given the momentum of GST collections, etc., part of that even adjusting for compliance, higher compliance, that seems to suggest that economic activity still remains fairly robust. So services activity too will be about close to 6%.
All right. At this stage, let me welcome in Madan Sabnavis, Chief Economist at the Bank of Baroda. Madan, minutes away from the third quarter numbers, and the big thing in the air is sub 5% quarterly growth. Not a number to be very happy about, but explain the reason to our viewers why indeed will growth slow down to that extent.
So actually, the slowdown in growth is primarily due to the base effect because of the higher number which we had last year. I think that's the reason why we're talking of a lower number in the third quarter and also in the fourth quarter. I think, but the right way to look at it is to see whether it goes along with what the RBI has projected, because the RBI has given its projections for the 4 quarters. It's talking of 4.4% for this particular quarter, which will eventually lead to an overall growth rate of 6.8%. So I think the target growth for the entire year is the primary part, and whatever number comes for the third and fourth quarters will be those numbers which sort of support this particular number. So I think when we're looking at third quarter, even though the number will look very much subdued compared to the first 2 quarters, and that's a kind of a declining trend which we're going to see. But as long as I think it comes in this particular region of, say, 4.5% or so, it would mean that we are on track to getting 6.8% growth, which will be still definitely quite an impressive number compared to what we're seeing in other countries, given the overall situation.
How much will do you expect a slowdown in exports, which everyone seems to be talking about, and some of the numbers point towards that direction, impact the number that we are awaiting?
No, in fact, what I feel is that India is basically a domestic-oriented economy, and if you look at the share of, rather the ratio of exports to GDP, I think it's much lower. It's probably in the region of around 12 or 13% compared to other East Asian economies, or even China, which is one of the economies which probably is looked as a kind of a benchmark for the emerging markets. And therefore, I think that even though there has been a major slowdown in growth in exports, that's not something which is really going to affect our GDP growth rate that significantly. And that's probably also one of the reasons why we are looking at a number above 6% for growth for fiscal 24, because even though there would be a recession in the West, or a slowdown in the West, where overall demand conditions are going to be definitely not as bright as what they were.
One of the reasons why I'm so thrilled about you.
That's right. And in fact, as we await the numbers, let me just recap for our viewers the trend that we have seen. Those numbers were flashing on the screen, and we have the number 4.4% for the third quarter. That's breaking news. Q3 GDP growth coming in at 4.4%. That number going up on your screen as we speak. Madan Sabnavis and Saugata Bhattacharya, your first quick reactions on that. Saugata, to you first. 4.4% in the third quarter.
Slightly lower than what we had expected, 4.6, but that's okay, because given the levels of uncertainty, it'll be the internals that will matter most. So that's the GDP number. What the GVA number would be, whether it's 4.3 or 4.4 or whatever, which will be the key indicator for this. And on the other side, we are talking about the demand, the supply side, agriculture, industry, services, where the number slowdown is coming in from the demand side. Personal consumption, private consumption, government consumption, investment, etc., will be a key thing to watch out for.
Madan?
You see, the impression I've just looked at the numbers, it looks like that the GVA increase has been something like 6.6%. So we are talking of a slightly more impressive growth rate than what we had expected. And I think the service sector has delivered very well, with all the sectors showing above 6% growth for the third quarter of the year. I don't know if I'm looking at the right numbers, Siddharth.
Yeah, go ahead. Madan?
No, I think you're able to hear me, Siddharth?
Yeah, go ahead.
Yeah, so I think this growth number seems to be more in lines with what the RBI has projected. So to that extent, I think it's not really off track. And we, of course, had a number of around 4.6% for the third quarter. So this would be slightly lower than what we had projected. But as I mentioned earlier, I think this number does say that we're very well on track of getting this number of 6.8% for the entire year.
All right, and we have some more details that are coming in at this stage. The full year growth number seems to have been retained, and the versus number that we are seeing on the screen for the comparable quarter should be 5.4%, and the latest number is 4.4%. The whole year growth that is being spoken about, and I'll request my producers to bring that estimate remains unchanged at 7%. Saugata, why would that be the case for a full year estimate to be maintained at 7%?
So again, we had actually expected a slight uptick to 7.1% given the numbers, because remember, these numbers are based on extrapolations of trends in the past. I mean, we still don't have the full year numbers. I mean, Q4 numbers are largely unavailable. So we were expecting a slight uptick in this to 7 from the earlier 7%, the first advance estimates, now to 7.1% in the second advance estimates, based on the leading indicators that we track. There was a small jump in the agriculture numbers, in the mining numbers, in the electricity numbers, etc. So we had expected a slight jump, but overall, this is completely on track. I mean particularly given the slightly lower number, the 4.4% in Q3. So this is probably on expected lines.
Okay, Madan, as we get more details about the numbers, and we are trying to bring that up. You very clearly, just to recap for our viewers at this stage, third quarter growth at 4.4%, below most of the estimates that we were seeing. The full year estimate being retained at 7%, and as we get more details on the numbers as we put them up, agriculture growth at 3.7% versus 2.3% in the same period a year ago. More of those details are coming in. Madan, given this, coming back to you again, your thoughts about what's happening as far as agriculture is concerned?
Yeah, I think the agriculture number for the third quarter at 3.7% is more a reflection of the Kharif crop. It does not tell us about what is going to be the fate of the Rabi crop. So I think this is pertinent today because we are talking of extreme heat conditions which have developed, especially in the northern part of the country. And that's something which has the potential to affect the wheat crop. So I think there could be some kind of a negative surprise out there. So while the overall growth which the NSO is talking of is 7% for the year, we would still stick to the number of 6.8% for the entire year. And I think the difference would probably be accounted partly by the agricultural production, which could turn out to be lower. But I think when I look at these numbers, Siddharth, I think most of the sectors seem to be doing very much on expected lines. But I see a negative growth when it comes to manufacturing, the value added in manufacturing. So I think that is something which would, again, I would say if it was expected, the number would be on the lower side because of the fact that a large part of this is based on corporate results. And the corporate results for the third quarter did show that profits had actually come down. If you remove the BFSI and the IT sectors, if you remove the service sector, we actually were looking at profits coming down. And I think that's something which is getting reflected in terms of manufacturing output going down. Otherwise, I think the other sectors, especially the service sector, has been showing a lot of buoyancy. And I think the pent-up demand, which was reflected even in the PMI numbers all through, is finally also getting reflected in terms of the value addition numbers, which we see in front of us for the third quarter.
Some more numbers that I have now, viewers, and I'll just take all of you through those. Please bear with me. India, October, December, the third quarter, mining sector growth has come in at 3.7% versus 5.4% a year ago. The construction sector growth is at 8.4% versus 0.2% same period last year. The October-December GVA number growth 4.6 versus 4.7% a year ago. Manufacturing, which was just being spoken about, has degrown, is at minus 1.1% versus 1.3% the year ago. Farm sector growth at 3.7% versus 2.3% a year ago. The FY22 GDP growth estimate has been revised to 9.1%. That is the revision that has happened for FY22, as you all know. The second advance estimate for FY23 and the first, second and third revised estimates for 3 financial years have also come in. FY23 GDP growth is unchanged at 7, and the details really. Saugata, I'm coming to you. Please share with our viewers what do you make of the sectoral numbers that we have just read out.
So, the first remarkable thing is the revision in the FY22 growth number that you mentioned, 9%. So that's probably one of the reasons why the 7% instead of the 7.1% that we were talking about has actually come about, because the base effect is now higher, base effect of the previous year's growth. Number one. Second, in terms of manufacturing, that we had a fairly good idea, because a large part of that also comes in from the IIP, where we know that there has been a significant amount of weakness in the third quarter. The IIP numbers are actually also negative. So I mean, so that is something which is expected. Overall, industry, which is a combination of manufacturing, electricity, and mining, the two together, and the mining numbers that you have just said. It was 3.7 is very strong. In electricity numbers too are relatively strong. So overall industry level growth will probably be around 2.2%. One of the reasons for the drop in the manufacturing segment is the fall in commodities prices. So that's one thing that would have taken the profits down, as Madan was also saying. So that's one of the reasons for the fall in the real growth of the manufacturing sector. But there is a volume weakness as well, and volume weakness is coming in largely from the export oriented, from the export sector. So that's agriculture growth still remains above trend, 3.7% above the trend growth of 3.5%. And I have no doubt that this is coming in from the non-core cereals-based agriculture, pulses, wheat, rice, etc., coming in more from the other horticulture, animal husbandry led sectors. So that's an encouraging sign, and because this is a little bit contrary to the narrative that we have been hearing about weak rural demand. So I mean, this hopefully will provide some impetus to growth, but there are risks. As Madan also pointed out, I mean, both in Q4 as well as FY24. So overall, but I mean, quite obviously, the entire momentum of growth and the services segment, including construction, is about 64-65% of GDP. So that's what is propelling growth in FY23. And I'm quite sure the upward revision in FY22 is also largely contributed from the services segment.
Just the absolute numbers for our viewers here once. GDP estimated at 40.19 lakh crore as against 38.51 lakh crore in the third quarter FY22, which translates into a growth of 4.4%, which is we've been discussing. And at current prices, it's nearly 70 lakh crore, 69.38 as against 62.39, which translates into a growth of 11.2%. Madan, again, your own reading of the sectoral numbers that we just discussed.
The sectoral numbers do show a bit of resilience, which we are seeing in terms of agriculture. We also do look at the service sector, which has been witnessing fairly good numbers in terms of the PMIs, which we have seen in the last few months. I think that's something which is getting reflected. And as I think Saugata was talking even earlier about the GST numbers being used for certain sectors, especially when you're looking at trade, I think that's something which has given a push out there. And we've also seen, for example, in the financial sector, that banking growth in deposits and credit have both been fairly buoyant. So I think all these factors have contributed to the services sector showing this kind of positive tendencies. The only disappointment, as I say, is back to the manufacturing sector, and I think that's been the weak link all through, and something which we should be seeing. We were hoping to see something positive happening, but that doesn't really seem to be happening. It's a combination of both the profits part as well as the fact that the IIP growth rates have not tended to turn things around, because that's what's used as a proxy when we're using the value addition from the SME segment.
Saugata, what could explain the fact that the government is retaining some of the upbeat assessment as far as the full year is concerned?
So again, from the government's point of view, this year is actually, I mean, the numbers are slightly better than what the government is estimating, probably. I mean, with for the full year in FY23. So close to about RBI is 6.8, government 6.9. I mean, so all of these numbers. So I mean, the numbers seem to be more or less in line, based on fairly realistic estimates for whatever is happening. But remember that FY23 is more or less over. We may not know the exact numbers, but we are done. The interesting thing now is the government's assumption, RBI's assumption for FY24, which are on the high side. Even the IMF's growth assumptions for FY24. IMF is estimating a mean of about 6.5, RBI is 6.4, although the government seems to be more moderate in the FY24 growth. So the slightly lower growth than expected, I mean, slightly meaning, I mean, almost negligibly so, I mean, 7.7% as opposed to 7.1. Probably also sets the tone for a slightly higher. In FY24, we are estimating about 5.9% growth. And this is response to the global slowdown that we expect in 2023. So I think now the focus, of course, Q4 still remains to be seen. Whatever we have heard, say the PMI numbers for services and for manufacturing suggest some growth in activity. The global situation seems to be far better than we had earlier estimated, both in Europe and particularly in the US. So that also provides a little bit of an upside window for India's growth in FY24. So let's see what the Q4 numbers probably look like, and then from there the stepping stone into FY24, which is the critical part. The second part is the nominal growth that you mentioned. That's something that we need to focus
on. What is the Q4 number that you are working with?
Slightly higher at 4.9%.
And Madan?
So we are looking at a number of 4.4%. That's what we had earlier. So we'll have to rework this number to see. But I think it'll be probably in that particular range, because we have a number of 6.8% for the entire year, and not 7%, which the NSO is talking of. So it'll be within this particular range.
Let's quickly sort of try and figure out how RBI mandarins will be looking at this data. They have their own way of, and they look through many data sets, as all of us know. But what would be the reading of the Reserve Bank of India from a monetary policy point of view, Saugata, with these latest numbers?
So this is probably one of the reasons why the majority of the members in the MPC, Monetary Policy Committee, remained very hawkish at the last policy statement in early February, earlier this month. That they did not change their stance, and they are signaling that they need to raise rates at least once more going forward in the April policy. So this suggests that their reading as well, and remember that they are forecasting again a 6.4% growth in FY24. So my sense is that their readings of the various data indicators that you are talking about, their surveys of industry, capacity utilization is relatively high, 75%. So all of that, their reading seems to suggest that aggregate demand still remains strong. They're reading that credit demand still remains strong, although we have seen that credit demand and the on-ground information that we are getting is credit demand for credit, particularly mortgage credit, home loans, demand from MSMEs, that is slowing down. So that all of these, and then of course there is the external environment that they judge to be much better than probably they had earlier expected. So that's basically the broad contours in which the lens, the prism through which the MPC and RBI will view the growth prism from which they will view monetary policy. And remember, this has implications for inflation, particularly core inflation persisting over a period of time.
The persistence of core inflation is one of the key concerns. Some more data, viewers, as we get that bit of a trickle this time around. But services sector growth has slowed down to 6.2%. Versus the comparable figure a year ago of 7.6, and we can see that industry growth at 2.4% versus 1.6% a year ago. Capital formation growth at 8.3% versus 1.2%. October, December, the third quarter that we are discussing, government consumption growth is a negative 0.8% versus 5.8% a year ago. Private final consumption growth 2.1% versus 10.8% a year ago. Madan, coming to you, especially on the last three: capital formation, government, and private consumption.
See, actually, Siddharth, the way I would look at it is that if you look at the GDP numbers in market terms, I mean, at market prices, that's the current prices rather than the constant prices, because that's what really relates to capital formation. See, what I've noticed here is that the share of capital formation has come down to something like 26.2%, which means that definitely this entire talk of saying that has investment really picked up, or is it picking up, is the private sector doing its bit? I think there is still a bit of apprehension about whether that part has really taken off. And if I just sort of juxtapose the core sector data which came out half an hour back, it actually gives the impression that lots of what's happening in the investment space is because of the central government rather than the private sector. Second part, which we see, if you look at the share of consumption in overall GDP, I think that number has actually inched upwards, which is probably expected because this is the time when we had a festival season where people were spending. So given the fact that we also had high inflation, less money was being saved, so money did get channeled finally towards the consumption side. So if I look at it in terms of the shares in overall GDP, that is consumption going up, capital formation coming down. Then there's a third component which you mentioned about the government. I think that's the sector which has probably been a kind of a letdown, because if you look at this public administration sector, which covers around 50% of the output there is coming from the government, the growth rate has actually been very low and quite disappointing at 2% normally. And I think that goes back to the fact that the government has been very careful in terms of its spending. And while definitely what we're seeing in terms of the capex front is taking place, but a lot of the other expenditures have been kept under control. So that's one of the reasons why we have seen that the public administration and other services has actually grown at just around 2% for this particular quarter.
Saugata, your view on those numbers that we just read out and are playing on the screen?
Right. So the first one is capital formation. Capex is actually growing faster than consumption, particularly even private consumption, although government consumption is. So the share of private consumption and capex has actually increased relative to the government. We know the reasons. I mean, government's own revenue expenditure, which goes into the public administration part. And public administration, remember, has a very large the small segment component built in as well, the other services. So from the government's capex perspective, because this is what is critical for sustaining growth into FY24. One of the reasons of the somewhat lower capex growth, the 3.4%, although that's pretty good, is that I think state governments this time, particularly all the way from April to December, have not spent on capex. The budgeted amounts in capex that they had earlier indicated, actual spends have been far lower. But now we understand that state governments are beginning to spend on capex. Obviously, I mean, this capex growth, I think, is predominantly coming in from the central government, as well as with some part, if we use credit growth to the commercial sector as a proxy. So even private sector capex is beginning to pick up. So that's one important part. The share of capex in the overall GDP is increasing. Private sector, private consumption, which is a worry, because, I mean, if growth investment has to sustain private sector investment, there would be some path, a runway, a visibility on private demand sustaining over a period of time. That is what will essentially lead to more private sector capex once their capacity utilization level is up to a certain point. So if there is signs of weakness in the private sector, or if we see that this private sector consumption is coming in from a few segments of the population, of the households, particularly from the upper segment, which is the inequality story that seems to be playing out, that is a matter for consumption, for concern going forward, and that's something which the government probably will need to address. This is in line with what we have seen, what we have heard, the narrative of the slowdown in the rural economy, the slower PFC, the private final consumption expenditure. That seems to be consistent with the narratives that have been playing out.
Saugata, just as an aside, for our viewers who get quite excited by comparisons and numbers and statements about India being the fastest growing economy, crossing 9% for the previous financial year versus the earlier estimate of 8.7 and now 9.1% is going to sort of set social media on fire, Saugata.
That you are the expert. I'll leave to you. But remember that FY22 largely coincides with the 2021 calendar year story, where we have
Yes.
seen that global growth has been very strong, overall 5.76% growth. But you are the expert on this.
Madan, I'm tossing that same question to you at 9.1%. Will that be the headline versus the slower growth in the third quarter?
No, I really don't think so. I think we're talking of the past, and I don't think, like as what Saugata was saying, that even probably 22, 23 does not really matter too much. And I think whether we're 7, 7.1, 6.8 really does make a difference. The critical part is what happens next year. So I think the social media will be more interested in whether these numbers augur positively or negatively for next year. And since we seem to be on track of this number of 7% for this year, I think 9% of last year, I really don't think that will make much of a difference.
Saugata, how does the global economic outlook look at this stage? When we last had a quarterly conversation, since then, some of the uncertainty seems to have ebbed. Inflation remains sticky, particularly in the United States, a bit of a surprise. But many of the uncertainties have calmed down. Oil is behaving in a certain sort of expected range. So, what's your own assessment? Has the tide turned a bit?
So on the global front, I think inflation has definitely peaked. The question now is whether it's going to come down towards the developed market targets of 2%. My own sense, it's not. Core inflation will remain sticky. The growth momentum in the US, although it's slowing, I mean, many sectors are slowing. But so housing is the one sector that is certainly the fresh housing starts, etc., new homes demand. So that is slowing. But overall, the retail sales, the capital goods in the data that has just come out in the last week, late last week, that seems to suggest the core capital goods demand remains very strong. Consumer goods demand remains very strong. On Europe, I mean, the moderate the winter has helped. Consumer confidence is increasing by the month. Every survey that of consumer confidence in Europe and the US is building up by the month. So my sense is, while the good news is that we will probably get at most a short and shallow recession in Europe and probably not at all in the US. The overall sense is that the central banks will probably have to keep raising their rates much longer and much higher than we had earlier expected. Markets were expecting a cut in the Federal Reserve's rate late in 2023, I'm sorry. But that's probably not going to happen. European Central Bank is going to raise rates higher, which will have spillover effects on India, unfortunately.
That's a good point. And market sentiment, once markets open tomorrow, will be perhaps reflecting, although markets may have already discounted some of the expectations around the GDP data. Madan, closing comments on this, especially from the same point of view of the global economic outlook.
So I think the global economic outlook definitely looks less disastrous of what one had thought of. So I think what we were talking of a deep recession, I think now we're not really talking of a deep recession. And definitely, I think if you look at the trends in terms of inflation in the US, it seems to be moving downwards. So while there could still be rate hikes by the Federal Reserve, but and probably there won't be any rate cut, but I think we generally know that we are probably on the right track. So while the global slowdown is definitely something which we have to work with, but as I mentioned earlier, that given the fact that the Indian economy is more domestic in nature, I think we need to continue and persevere with our policy framework, which the government has been doing for the last few years, to ensure that we're able to reinvigorate the private investment cycle. That's I think, the missing link as far as India's growth story is concerned. The global economy will, of course, affect us more through the flow of funds, the FDI, the FPI, and that's something which will be affecting the currency. And I think the RBI has a tough job now for the next year, not just inflation, but also currency management.
Absolutely. And viewers, as I leave you with the data, just to recap once again, third quarter growth has come in slower and lower than expected at 4.4%. The broad consensus estimate was 4.6%, and the familiar reasons: weak demand, inflation and the consequent aggressive rate hikes, and the normalization of the base effect also at play here. The second major headline, the government still expects India to grow at 7%. And for the previous financial year, although that's now well behind us, India grew more than 9% and 9.1% as a headline number, quite an impressive number. But the current quarter and what lies ahead in the new financial year, at least for 2 quarters, will be very crucial to see how India rides out of the problems that are centered around inflation and the fact that the government still has to continue to do a lot of heavy lifting as far as growth is concerned. Madan Sabnavis, Saugata Bhattacharya, thank you very much for your time with us. With that, it's a wrap on this episode of Easynomics. We'll be back with more. Do stay tuned in. Until we meet again, goodbye.
If you like the video, do like, comment, share and subscribe.